We're going to talk about how to analyze commercial properties. The market value of single-family homes is determined very differently than multifamily or commercial properties. Commercial properties are defined as 5 units or more. The value of single-family homes are determined by sales comparisons of similar properties in the same area. Larger or commercial properties are valued on how they perform financially, namely how much profit or income they produce. The fact commercial properties are valued based on their income potential shows how important a good financial analysis is. I will show you the calculations you need to perform and how to do them. This analysis is the same whether it's a 10-unit building or a 500-unit building. One word of caution, a lot of sellers and/or brokers will try to give you what's called pro forma numbers. Pro forma basically means estimated or best guess. Numbers the property might produce if certain things are done in the future. You want to base your financial analysis on actual numbers only, how a property is performing right now. You want to determine what the true value of the property is today, not at some point in the future or if certain things are done or what might happen, etc. Why reward the current owner for something he hasn't done, paid for, or hasn't happened yet? Okay, let's get started. For our example, we are going to use a 20-unit building with an asking price of $1 million. It will have an annual net revenues of $200,000 and annual net operating expenses of $100,000. Nice round numbers, keep it simple. The first thing we want to determine is what is called net operating income, or NOI for short. Take your annual net revenues, calculated as gross rents, plus any other income, laundry, vending machines, etc., then subtracting vacancy. From our example, our net revenue is $200,000. Now we take net revenues and subtract our operating expenses, which from our example is $100,000. So $200,000 minus $100,000 gives us our NOI of $100,000. Now we have our NOI. This is a very important number. This number is what we look at for value, but more importantly, this is what banks key on when they are determining value of property and how much money they will lend on the property. Next, we have to determine our capitalization rate, or cap rate for short. To calculate our cap rate, we simply divide our NOI by the purchase price of the property. So net operating income divided by purchase price will give us our cap rate. We have our NOI as $100,000 and our purchase price of $1 million. So 100,000 divided by 1 million equals 0.10, or a 10 cap rate. You can now compare the cap rate for our property to the market cap rate for similar properties in your area to determine if this property is priced high, low, or on the market. If our cap rate is higher, it's cheaper. If our cap rate is lower, it's more expensive. You also want to be able to play with the formula a bit. If you have the cap rate and the NOI, you can determine what the property should be worth, etc. So NOI divided by cap rate equals purchase price, or value, as opposed to NOI divided by the purchase price to give us our cap rate. The next number we need to calculate is our cash-on-cash return, COC, but first we need to know what our annual debt service is going to be. We will structure our financing with a typical 25% down and finance 75% with an amortization of 25 years and an interest rate of 5% for 5 years. From our example, we have a purchase price of $1 million, so we will finance 75%, or $750,000. This gives us a monthly payment of $4,362. We multiply that by 12, gives us a $52,344 annual debt service cost. We next subtract our debt service from our NOI. This is called cash after debt service, CADS, or sometimes called cash flow before taxes. So we take our NOI of $100,000, we subtract our debt service cost of $52,344, and we get a CADS of $47,656. To calculate our cash-on-cash return, we now take our CADS and divide it by our down payment, which is 25% of our $1 million purchase price, or $250,000. So our CADS of $47,656 divided by our down payment of $250,000, we get 0.19, or 19%. This is the return on our money. Our money is the down payment. The higher the number, the better our return. Our next number is called the debt service cost ratio, or debt cost ratio. This is the number the banks look at to determine how strong is a property's capability going to be to service the debt. To calculate this number, we take our NOI and divide it by our annual debt service. So our NOI of $100,000 divided by our debt service cost of $52,344, we get a ratio of 1.91. So this property shows a net income almost 2 times its debt cost. Banks look for 1.2 or 1.25 or higher. The higher the better. So our property shows very strong as far as its ability to service its debt, and banks like that. So let's recap. We have learned how to calculate net operating income, or NOI, our capitalization rate, cap rate, our cash after debt service, or CADS, our cash on cash return, and our debt cost ratio. You will need to calculate these numbers for every property you analyze. After a few, you will see how different properties compare, whether it's revenues and expenses, or its purchase price versus its cap rate, etc. You will be able to determine fairly quickly and confidently if it is a deal you want to pursue. Your next step is just to go out and start analyzing properties. You will get the hang of it very quickly. If you have any questions, contact us at www.offspringinvestments.com and we will gladly answer them. Good luck and all the best.